Stop staring at red candles on a screen. Stop listening to analysts telling you the dollar has been saved. And for the love of common sense, stop panicking because silver dipped to $83. While you were distracted by paper games in New York, the real move was made somewhere else entirely. Beijing. The United States thinks it won yesterday by smashing prices. China is preparing to win the war by flipping the entire board. It's Tuesday, February 3rd, 2026, and the most important news today is not gold's price. It's an article just published in Kaiashi, the flagship theory journal of the Chinese Communist Party. And before you dismiss that, understand this. Kaiashi is not a magazine, it is policy. This is the voice of President Xi Jinping, and he didn't write this to debate philosophy. He wrote it to issue orders. In this article, Xi states clearly that China must build a powerful currency capable of challenging US dollar dominance. He calls for accelerating the yuan's international role, but more importantly, he ties currency strength directly to national security. That matters, because when China talks about security, they don't mean confidence, they mean survival. This is Beijing saying, out loud, that dollar hegemony is no longer acceptable, and that the next phase is about hard backing, not promises. Look at the timing. Why publish this now? Why release it less than 24 hours after US banks slammed gold and silver prices? Because Beijing sees weakness. That paper smash wasn't strength, it was desperation, and China is countering with the one weapon the US can't print or intimidate away: physical assets. Behind the scenes, reports are building that this article is a setup, a signal, a precursor. For years, China's official gold numbers have made no sense. Tiny monthly additions, laughable totals. But the flows tell a different story. Imports through Hong Kong, domestic mine output, state-controlled accumulation routed through military and safe accounts. The math doesn't lie. China hasn't been stacking tens of tons. They've likely been stacking thousands, quietly, patiently, waiting for the right moment. Now imagine what happens next. US markets are already fragile. Debt pushing 38 trillion, confidence hanging by a thread. And then China holds a press conference. No tanks, no missiles, just a spreadsheet. They announce their real reserves. Not 2,000 tons, not 30,000. Suddenly, the yuan isn't theoretical, it's anchored. And in that moment, the world understands something brutal. Gold wasn't rising before. It was being suppressed. What happens to the dollar? It doesn't drift lower. It breaks. What happens to gold? It doesn't climb. It reprices. 4,000 becomes 10,000, not because of speculation, but because reality finally shows up. This isn't an attack, it's a demonstration. The financial version of a military parade. A message to Washington that says, you can control paper, we control metal. Checkmate. And the craziest part? The US won't be able to respond with force, sanctions, or speeches, because you can't bomb a balance sheet, and you can't negotiate with physics. This is why today matters, not because prices fell, but because the rules are about to change. And here's the part nobody wants to admit. By smashing the price yesterday, US banks may have accidentally helped China do exactly what it wanted. That fake crash to $83 didn't scare China, it gave them a discount. Strategic assets were put on clearance right before a potential reveal. Gold and silver got cheaper, and China is laughing all the way to the vault. Every ounce of silver leaving London and New York right now is being pulled east. Not because of ideology, because of math. This isn't emotion, it's arbitrage. And to understand why Western vaults are bleeding, we need to talk about one number and one analyst. David Jensen. David is one of the few people who doesn't stare at futures charts all day. He tracks the plumbing, the physical movement of silver bars. And he just flagged something that should be setting off alarms in every bullion bank on the planet. A vacuum. A vacuum so powerful that it's mathematically impossible for Western inventories to survive it. Here's how it works. Right now, silver on the Shanghai Gold Exchange is trading at a massive premium compared to London and New York. The paper smash pushed Western prices into the mid-80s. But in China, the price didn't flinch. Chinese buyers are paying roughly 29% more just to secure physical metal. That's about $23 per ounce above Western spot. And it gets worse. Inside China, silver is subject to a 13% value-added tax. When you add that in, The true replacement cost of silver behind Chinese borders is about $36 higher than the Western price. $36. That's the gap. Now look at logistics. To ensure, secure, and fly a ton of silver from London to Shanghai costs about $2 an ounce, maybe $2.50 if you want it fast. So do the math. $36 minus 2. That's a $34 profit per ounce. Risk-free. In financial terms, that's free money. If you're a bullion bank, a trading house, or a miner, why would you sell silver in New York for $86? Why would you leave it in London? You wouldn't. You palletize it, you put it on a plane, you fly it east, and you sell it for around $120. That's a 40% return on a 12-hour flight. There is no better trade in the world right now. And this is the vacuum. Capital always flows to the highest return, and silver always flows to the highest bidder. Right now, China is paying a $34 bounty on every ounce of silver on Earth. They are openly saying, bring it to us. Empty your vaults, drain your ETFs, we'll pay you. And the Western banks are doing exactly that. Because arbitrage doesn't care about national security, it cares about bonuses. While the US plays checkers with derivatives, China is playing go with bullion. Slow, patient, irreversible. The paper smash wasn't a victory. It was a smoke grenade. The real army is moving in the background. They are draining the LBMA vaults in London. They are draining the COMEX vaults in New York. This isn't theory anymore. This is inventory leaving. Every day that arbitrage gap stays open, thousands of silver bars exit the dollar system and enter the renminbi system. And once that silver crosses into China, it does not come back. China does not export silver. They absorb it. It goes into solar panels. It goes into missiles. It goes into electronics. And it goes into the foundation of the stronger currencies I just ordered. That's why the paper smash was a catastrophic strategic mistake. By forcing the US price down to $83 or $86, they widened the arbitrage. They made it more profitable to ship metal east. They effectively put their own strategic inventory on clearance sale for their biggest rival. They thought they were defending the dollar by painting a scary chart. Instead, they subsidized China's accumulation. This is what happens when you sell the family farm to pay the credit card bill. And make no mistake, Washington knows it. They have satellites. They can see the cargo planes. They know exactly how much metal is leaving. And they know the math. If this vacuum runs another few weeks, registered silver at COMEX goes to zero. That's not a price problem. That's a physical default. That's why the mood in Washington has flipped from confidence to panic. That's why, suddenly, you're hearing emergency language about critical minerals. That's why doors are closing and meetings are happening off calendar. We need to talk about Marco Rubio. Tomorrow, Wednesday, February 4th, 2026, the State Department is hosting what looks like a boring event on paper, the inaugural Critical Minerals Ministerial. Rubio has summoned officials from Europe, Japan, South Korea, Canada, and Australia. The press release says the goal is to strengthen and diversify critical mineral supply chains to ensure economic resilience. That's the official language. Here's the translation. China is taking everything, help us. This is an attempt to build a NATO for metals, a last-ditch effort to slow the Chinese vacuum that's draining the Western alliance. Because Washington has seen the same data David Jensen has. They see the $34 gap, and they understand what it means. Silver is no longer just money. It's the new oil. You cannot build a green energy grid without it. Solar panels require silver. You cannot build advanced AI hardware without it. High-end chips rely on silver interconnects. You cannot build a modern military without it. Missiles, fighter jets, satellites, guidance systems all consume silver. And here's the part that should terrify policymakers. The United States consumes roughly 5 times more silver than it produces. We are dependent on imports. Mexico, Peru, the global market, and China is currently buying that market out from under us with a 29% premium. Rubio knows that if COMEX runs dry by March, as the math suggests, the U.S. military-industrial machine starts seizing up. That's when Lockheed Martin starts calling the Pentagon. That's when defense contracts slip. That's when timelines break. You can print dollars. You cannot print silver. And right now, the metal is leaving. Not slowly, not quietly, relentlessly. And that's when the phone rings. Lockheed Martin calls the Pentagon and says, We can't build the guidance systems. We can't get the silver paste. That is a national security nightmare. So make no mistake, this meeting tomorrow is not a trade summit. It's a war council. Washington is going to try to strong arm its allies. They'll push for agreements restricting the export of critical minerals to so-called non-market economies. That means China. They'll talk about banning arbitrage trades. They may even float capital controls on strategic metals. You can't ship silver to Shanghai. It's a matter of national defense. Here's the problem. It's too little. Too late. You cannot legislate away economics. You cannot stop water with a piece of paper. As long as silver trades $36 higher in Shanghai than in New York, the metal will move. If not legally, then creatively. Smugglers will move it. Third-party countries will reroute it. Black markets will fill the gap. Because price is truth. The only way to stop the drain, the only way, is for the Western price to rise. New York has to meet Shanghai. The suppression has to end. Silver has to move toward 120 just to keep it inside the system. This meeting is an admission of defeat. It's the US government quietly admitting that the free market they claim to champion is now turning against them because they held prices too low for too long. They pushed the beach ball underwater. Now it's exploding back up in their face. Rubio is trying to hold it down with executive orders. It won't work, and the market knows it won't work. That's why, despite yesterday's paper smash, prices are already fighting back. That's why sentiment didn't break. Traders can smell desperation. And when governments start holding emergency meetings about supply chains, it means one thing: the cupboard is bare. Now, if you want to understand how bad this really is, you have to stop thinking like a trader and start thinking like a physicist. Markets obey laws, and the most basic law of financial physics is gravity. Water flows downhill. Capital flows to where it's treated best. Commodities flow to the highest bidder. You can't negotiate with it. You can't vote it away. Right now, the United States has created a gravitational singularity in Shanghai that is swallowing the world's silver. Think about the irony. Yesterday, the U.S. Treasury and its banking partners spent billions in paper derivatives to smash silver down to $83. The goal was to make fiat look strong and metal look weak. Instead, they committed one of the greatest strategic blunders in modern financial history. They put the most critical strategic material of the 21st century on clearance sale. They hung a neon sign over comics that said, "Everything must go, 30% off." And China didn't panic. They didn't sell. They said, "Thank you." They backed up the trucks. What we're witnessing right now is the great migration of physical capital. Armored trucks leaving warehouses in New York and London. Bars loaded onto cargo planes. Flights heading east. Those bars are leaving the Western system permanently. They are exiting the LBMA, the heart of the Western fractional reserve metal market, and they are entering the Shanghai Gold Exchange, a physical lonely fortress. Once a bar enters the SGE, it is melted, assayed, and restamped with Chinese characters. It is erased from the Western ledger. And once that happens, it never comes back. That drop wasn't a warning. It was a gift. China saw the $34 arbitrage gap and immediately understood something simple. Silver at $83 was mispriced, so they bought it, aggressively, with both hands. This is the textbook definition of a failed suppression. And in technical analysis, a failed move never ends quietly. It reverses violently. When you try to hold a beach ball underwater and lose your grip, it doesn't drift up. It explodes. That's what we're seeing now. The shorts, the entities that sold yesterday hoping to push silver to 70, are trapped. They sold the bottom. Now price is back to 86. As it ticks to 87, 90, and higher, those shorts are forced to cover. They become buyers. That's the fuel for a squeeze. The war shock was supposed to kill the bull market. Instead, it confirmed it. It proved that even with the full weight of the US government and the banking system leaning on the market, silver could not be held below 85 for more than a day. That's not noise. That's a floor. And if 85 is the floor, the ceiling isn't defined. Now look at the physical reality behind this bounce. While paper prices whipped around, the physical market in Shanghai never blinked. Chinese buyers don't watch cable news. They don't care about talking heads. They care about volume. And volume on the Shanghai Gold Exchange is exploding. They are draining the world of metal, and the Western price must rise to catch up. That arbitrage vacuum guarantees it. Unless silver in New York rises toward 120, The metal keeps leaving. There is no alternative. So this price move isn't speculation, it's necessity. It's the only way to stop the bleeding. Eventually, even the US banks will be forced to go long. They'll have to let price run just to prevent COMEX from defaulting. The attempt to save the dollar has backfired spectacularly. They smashed the paper price. The metal bounced. And now the dollar looks weaker than ever, because it couldn't even suppress silver for a single full session. The illusion is cracking. The Fed has no bullets left. The cartel has no silver left. And that sets the stage for the final act. We have the signal from Xi calling for a powerful currency. We have the arbitrage vacuum pulling metal into China. We have panic in Washington as emergency meetings are called. And now we have price confirmation. The board is set. All that remains is positioning. Do you want to be holding paper issued by a system losing a geopolitical war? Or do you want to be holding the asset the winning side is accumulating? Here's the verdict. The dots are connected. Xi issued the order. The arbitrage drained the West. Washington panicked, and the price refused to break. Yesterday, the United States played its final card. They used war headlines and a massive paper dump to scare you, to crush price, to defend the dollar. Instead, they put the most strategic asset on earth on clearance sale. The US smashed the paper price. China said, "Thank you." And then they backed up the trucks. Now the vaults in New York and London are emptying at record speed. Silver is flowing east like a river, and it is not coming back. The emergency meetings are happening because Washington knows what comes next. Once the metal is gone, the paper doesn't matter anymore. And when the announcement finally hits, it won't be loud. It will be simple. And it will change everything. They know what comes next. They know that by March, if this flow continues, COMEX becomes a hollow shell. Paper claims no metal. They know that Pax Silica, the idea that America controls the technology supply chain, is finished without silver. That leaves only two possible outcomes for the Western silver price. Option 1. Price collapses to zero because there is no physical metal left to trade. Option 2. Price explodes higher to match Shanghai. There is no third option. That $34 gap is not an opinion. It's a law of nature. And it will not close by China coming down. It will close by New York going up. The suppression has failed. The dam is breaking, which means this was your second chance. That violent crash wasn't the end. It was a window, a brief opportunity to buy silver at a discount, subsidized by the mistakes of central planners who no longer control the physical market. Don't waste it. Don't let volatility scare you out of position. That's what it's designed to do. The squeeze is not over. It's just beginning. The financial military parade hasn't started yet. But the staging is complete. Ignore the paper. Trust the flow. The East is buying. The West is panicking. The price is rising. The squeeze is alive. This is John A. Game over.